This is happening right now in Florida, and it is not a slow problem. Condo buildings are opening renewal letters and saying insurance jump around 40%. No warning, no mercy, just a number so high it detonates the budget. And when that budget detonates, your monthly cost of living can spike overnight, even if your mortgage never changes. Pause here, because this is the part most people miss. Insurance is not just an annoying line item. In Florida condos, insurance is the load-bearing wall of the entire housing payment. When it cracks, everything above it starts to shift. Here is the uncomfortable reality. Florida's condo insurance market is panicking. Carriers are repricing risk, pulling back coverage, raising deductible, and forcing associations to scramble. And the governor and regulators are trying to patch a moving engine while it's on fire. Think about what that means. A typical owner expects predictable housing costs, are mortgage, taxes, HOA. But if the HOA is carrying a building level insurance bill, that's certainly spike. The HOA has two options: raise monthly dues or slam owners with special assessments that can hit five figures. And that is where things start getting scary, because a five-figure bill is not a budgeting inconvenience. It is a forced decision. Pay it, borrow it, or send. Now, let me show you how this pressure spreads, because it does not stay inside one building. It bleeds into property values, mortgage approvals, rent prices, and the basic ability to live in your own home without financial anguish. Start with the mechanic. Most condo owners do not buy their own for building insurance. The association does. That means the association is the customer, and every owner is effectively tied to the same insurance shockwave. So when premiums jump around 40% at renewal, the association cannot just share. They must pay. They must maintain coverage. And if fewer insurance want the business, the association has less bargaining power, less competition, more expensive quotes, stricter term, higher deductibles, more exclusion, and a whole lot more. Take it or leave it. But the real problem is this: leaving it is not an option. If the association cannot secure adequate coverage, lenders get nervous. Some lenders stop lending. Some buyers cannot get approved. Some deals collapse. And suddenly, the building is not just expensive. It becomes harder to sell at any price that makes sense. Let that sink in. Insurance does not just raise your cost, it can chalk up demand for your unit. Now, this solution becomes more dangerous when you layer in what has changed in Florida condos. After high-profile structures failures and growing student, many buildings are under pressure to increase reserves, accelerate repairs, and prove they are financially and physically stable. That sounds responsible, and it is, but it is also expensive. And it is hitting at the same moment insurance is spiking. This is where the pressure compounds. Owners are not just facing HOA because of insurance, they are facing higher HOA because of repairs, reserves, inspection, and compliances. So when a renewal hits, the premium jumps 40%. It lands on an already strained system. And then something else breaks, because not every owner can absorb that hit. Retirees on fixed income. Working Sam is already stressed by food, car insurance, and utility. Investors who plan for predictable carrying costs. Suddenly, the math slips. But used to be a manageable monthly payment becomes an unpredictable liability. And the worst part is the timing. These increases often show up fast: a budget revision, a board, a notice, and then the bill. Now consider the psychological impact. A lot of people buy condos for stability, lower maintenance, predictable shared cost. But in this environment, shared costs are the threat. You are conventionally tied to a building's risk profile, the insurance market's mood, and the claims history you do not control. They data bin. You can do everything right personally and still get financially hit because the building is caught in a market panel. So why is this happening now? Because Florida is the perfect storm. More storms, higher rebuilding costs, more litigation risk in the broader insurance ecosystem, tighter reinsurance, and insurance looking at the map and saying, we're not pricing yesterday's risk anymore. This detail matters. Insurance companies do not wait for a catastrophe to change prices. They move when they think the probability and cost of loss is rising. and Florida has been sending signals for years. But here's is where it gets worse. When insurance retreat, the remaining option get more expensive, and some association end up forced into limited choices that can feel like a penalty box. Higher premiums, thinner coverage, and massive deductibles that make smaller events painful too. So even if your building does not suffer a headline-grabbing disaster, you can still lose because the premium is not just about your building. It is about the entire risk environment. Now let's talk about the domino effect that nobody wants to say out loud. The domino effect is forced sales. Picture an owner getting hit with a $15,000 special assessment plus a monthly HOA jump. They may not have $15,000. They may not qualify for a loan. And even if they do, interest rates make them not expensive. So this there. But selling is not simple when the building's HOA is rising and the market knows it. Buyers compare monthly payments, not just sale price. A unit that looks affordable at $350,000 become unaffordable when the HOA adds another $400 to $700 a month. Pause here. This is how prices soften without a dramatic crash headline. This stricter price might not collect overnight, but the pool of buyers sting. Days on market stretches. Price cuts become normal, and owners would need to sell, discover the market has changed under their feet. And then the next pressure wave arrives. If enough owners cannot pay the assessment or the higher dues, the association's cash flow gets stressed. This can lead to deferred maintenance, more risk, one insurer concern, higher premiums, and you can feel this spiral forming. This is where fragility turns into exposure. An insurance fight does not just hurt individual owners, it can undermine the financial health of the entire building. Now, through how to the Miami and South Florida specifically, you have high density condo inventory, you have heavy investor presence, you have coastal risk, you have expensive construction costs, you have a housing market where affordability is already time. So when tens of thousands of units are at risk of affordability failure, that is not a niche problem. That is a market problem. Let that sink in. If a meaningful slice of condos become unaffordable to carry, you do not just get stressed owners, you get post-listing volume. And forced listing volume is how prices start to bend. But the real damage is how it hits financing. Because lenders do not just look at you, they look at the building, they look at the insurance, they look at reserves, they look at delinquency rates, they look at pending assessment. And if the building trips certain red flags, buyer can get blocked. Nothing about that. You might have a buyer ready to go, but the building fails lender requirement. So the buyer cannot close. So the seller has to drop price or wait. And waiting costs money because the HOA is rising while you wait. This is where squeeze gets personal. You are paying more each month and the exit door is narrow. Now let's talk about the political pressure. Because when this starts hitting enough middle class and retiree owners, it becomes a crisis politicians cannot ignore. This state can talk about reform and emergency fixes, but insurance markets move faster than legislation, and that gap is that way. Because homeowners live on monthly cycle, associations have renewal dates, and bills hit on schedule whether telehappy is ready or not. So, even if there is an emergency fix, here is the hard truth. A fix does not automatically translate into lower premiums next renewal. It might stabilize, it may slow the bleeding, but in a panic, insurance are not charitable. They are defensive. This is why people feel blindsided. They hear fixed and expect relief. But what they get is choice between bad and worse. Now consider renters. You're not safe from this. If condo owners get hit with higher HOA and assessments, many try to raise rent. And if owner cannot raise rent enough, this can. Units turnover, inventory shift, and renters get caught in the chain. This is where it turns into a community-wide cost shock. Higher HOA pushes rents, higher insurance pushes HOA, special assessments push forced sales push pricing pressure changes comes, and comps change everyone's assumption about what their home is worth. And here is the part nobody expects. This can happen even during a strong housing market because this is not about demand, it is about carrying costs. A market can have buyers, but if the monthly payment is unstable, buyers hesitate. Hesitation is everything in real estate. Hesitation kills offers. Hesitation kills prime. Hesitation is liquidity. So, what should you watch for right now in real life? Not headline, paper. Watch for actually notices about insurance renewals. Watch for reserve studies. Watch for special assessment votes. Watch for rising deductibles that effectiveness shift this back onto honors. Watch for lenders questionnaires getting stricter. And watch for units in this same building being longer than they used to. This detail matters. The warning signs show up first inside the building before they show up on the news. Now, if you own a condo in Florida, especially coastal, you need to ask direct question. When does the master policies renew? How much did it increase last cycle? How much is projected next cycle? What is deductible? How funded are results? How many owners are delinquent? Are there planned assessments? Has the building been flagged by lenders or insurance carriers? Because if you do not ask, you are trusting becomes circle why pressure builds underneath. And if you are thinking about buying, do not just tour the unit. Interrogate the building. A beautiful kitchen does not matter if the building is a financial trap. A view does not matter if the HOA can jump again with 30 days notice. Pause here. The new luxury in Florida condos is not marble. It is predictable monthly cost. And that is exactly what a market is losing. Now let's get brutally clear about the risk. A 40% payment spike is not a one-time annoyance. It resets the baseline. And once the baseline moves up, every future increase stacks on top. That is how people get priced out of homes they already own, not by losing their job, not by a recession, but by compounding carrying costs that never come back down. So when you hear Florida conduct insurance market panic, do not picture something abstract. Picture the moment a board realizes the new premium is hundreds of thousands of dollars higher. Picture the emergency meetings. Picture the budget gap. Picture this passion assessment letter being drafted. Picture the owner who has to choose between draining savings or listing the unit. That is the real story, and it is spreading because the market is not waiting. Renewal are coming due, insurance are rewriting terms, and owners are absorbing the shock in real time. So the question is not whether this will affect housing in South Florida. The question is how many people it hits before the system finds a new equilibrium and work break in the meantime. If you live in Florida, on property, rent, or plan to move, treat this like a warning flare. This is kind of cost chop that turns safe housing into monthly gambler. And the most dangerous part is how quietly it starts. One renewal, one assessment, one actually jump. And suddenly, their home is not just a home, it is a liability with a due date.